Hello everybody, this is 80 from forexpreparation.com. Today I would like to talk a bit about market psychology and the way I trade. And the best way to do that is to start with a short introduction about trading, and that's in my opinion the great trades do not require predictions because they're based on something that has already happened, and that's why most of the great trades are incredibly obvious. But of course there is one factor that is a key, because otherwise, if it was so simple, everybody would have been a multimillionaire. So in my opinion, the most important factor about successful trading is the implementation, and it is more important than the trade idea behind it. So having a great idea will not get you far if you don't do it the right way. That's why if you want to be successful in trading, you just have to pull a trigger sometimes and then think. So in my opinion, that's it is very important that sometimes you just get into a position with a very small, into a trade with a very small position, so you can feel the trade, and then you decide to whether to cut your trade or just to start scaling in at appropriate levels. So here comes the most essential thing, and it is position size. So it should be your position size and your stops should be as big as necessary to compensate for daily fluctuations. So for example, if you're putting an automatic stop, it should be in a place where you're sure that if you're right, the price won't go there. So that should in any case shouldn't be a predefined number like 10, 20 or 30. It's should be a level corresponding to the current trading environment. Therefore, I don't recommend that you're using set rules. So in my opinion, they do not work here because the markets are changing very dynamically every day, every hour. So you should use your own flexibility and reason to place your stop every time you trade. That's why I believe that automatic systems do not work well, and the best uh, the best trades are coming from your own intuition, which is actually based on your past experience and subconscious thinking. That's why I believe that the right key to successful trading comes with experience, and with experience comes right positioning. So you should be scaling in when you're on the right side of the trade and quickly scaling out when you're wrong. In my trading, for example, I do not use indicators. I just use the psychology of the market by implementing price action and matching patterns on different time scales. I use daily for the general picture of the markets, 1 hour for giving me the potential signals, and 5 minute time scale for precise entry levels, so I can minimize my risk. And because I know when, for example, there is a big trend like a straight line like here, I know exactly where I can enter and put my stop levels, but it should be really a quick move, a straight line like this one in the center of the chart right here. So uh, now let's look at an example. It's a good moment to look at the chart that is in front of you. As you will see, actually there are two examples that I have prepared. One of them is the one that you see, and the other one is this one. So I will concentrate first on this euro-dollar chart from 2008, and I have chosen this screenshot from 2008 on purpose. I am not going to use a real-time chart right now for my first video, so I would like to show you that actually the general psychology of the market players was the same in 2008 and 2013, when in a later video I would be showing a live trading on the currency market. So I believe that it will continue to be the same in the years to come, because human nature is the only thing that doesn't stop working, unlike indicators and other trading techniques which working for a certain amount of time and then they stop working. So what I'm looking at this chart is pretty much where the big buyers are located, and I would like to ask you to think about this for a few seconds before I continue. Where in your opinion the big buyers are located, and how is this action expressed?